afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before I introduce today's presenter, a few quick reminders as always. Everyone that is registered for today's program will receive a copy by the end of next week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Today, we welcome back Brianne Eagles, Senior Manager at Moss Adams Automotive and Dealer Services Group. Brianne, I know you have a lot to discuss today, so I'll leave it to you.
Thank you, Rachel, and welcome everyone. So today, this is what we're going to be covering. So we're going to talk about tax credits and incentives. We're going to focus a lot on the employee retention tax credit. We've been getting tons and tons of questions from clients on this area. We'll touch on the tax legislation proposals that we're dealing with right now that you're probably hearing in the news every single day. Touch on the pass-through entity level tax collections, otherwise known as the SALT cap workarounds, and just go through a couple reminders on tax reform that are coming to be an issue again in the next couple of years. So start off with the employee retention tax credit. Like I said, this is an area we've been getting a lot of questions about. There's a ton of questions about whether or not dealers just blanketly, every dealer in the US would qualify for this credit. There are a lot of specialty providers out there making calls to our dealers, telling them that they do qualify. And so we'll talk a lot about how they're getting there and where you might want to be cautious and what might qualify you and what might not. So to start, the way this started was with the CARES Act back in March of 2020. The ERTC was included in that legislation, but at that point, if you took a PPP loan, you were not also eligible to take the ERTC. So, most dealers at that point kind of wrote off the ERTC as something that they weren't going to do. The PPP was a far superior program. They took their money and forgot all about the ERTC. With the Consolidated Appropriations Act, it had some changes to it. It extended the credits through June of 2021 and also took away the restriction on PPP loan recipients. And so PPP loan recipients could now go back and take ERTC if they were eligible. And then we got further enhancements in the current year under the American Rescue Plan Act. And so the ERTC, it would now be eligible or would now be available through the end of 2021. However, the infrastructure bill that went to the president just late last week includes an early termination of the ERTC. So it makes it only available through Q3 of 2021. There is some talk that maybe there'd be a reinstatement through the end of Q4 2021 in the recovery bill, but it's not in there now. So there is a chance that as of 9/30/2021, there is no more ERTC. So who's eligible? So I'll start with the part that is very clear cut. There's a really easy way to test, and that's the gross receipts reduction test. So if for any quarter in 2020, you had a reduction of 50% or more of your gross receipts compared to that same quarter in 2019, then that quarter would be eligible for ERTC. For 2021, you only had to have a 20% reduction in your gross receipts for a calendar quarter compared to that same calendar quarter of 2019. So again, using 2019 as the base year for both years, but for 2021, the rules got a little better that you only have to have a 20% reduction. So again, that's the really easy test. It's very clear cut, very straightforward. The other test is the one that we're getting lots of questions about, and that is what qualifies an employer under the partial suspension due to government order rule. So for the most part, this is going to be a very facts and circumstances based for each and every dealer. It's going to depend on which jurisdictions you were in. because most dealers were deemed by their state or their local governments to have been an essential business, a lot aren't qualifying under this because they weren't really subject to a suspension that was large enough to have qualified them. We have had a lot of questions on the supply chain disruption issue, but even there, and we've talked to our peer firms about it as well, there's a lot of question of whether or not that supply chain disruption has to be due specifically to a government order. So, right now, lack of inventory, is it due to any specific government order, shutdowns? More than likely not. However, I think this is an area we should keep watching because we do expect to see some audit activity in this area. And we may find a year from now or more that these rules are a little more lenient than we're interpreting them to be now. I'll talk about it in just a few slides about, the timeline you have to claim these credits. And so just know that while, you're not getting the money today, potentially, if you're worried about whether you qualify or not, there may be an opportunity to claim these credits later. And it really does come down to evaluating the risk of taking the credits, because if you do take the credits and you weren't eligible, you're subject to penalties and, up to 20%. So, that's a big chunk and a big risk to take. And so, potentially waiting to take the credits for a little bit may be the better approach. But as you're being approached by these specialty providers offering to claim the credits for you, definitely call your CPA, talk it through, understand your own situation, and make sure that you're proceeding cautiously and not taking a risk that you don't understand. So if you find that you are eligible, the next test is the employee threshold. For 2019, only employers who had 100 or fewer full-time employees were eligible. For 2021, it goes up to 500 or fewer employees. So it gets, again, here we see the rules getting a little more lenient in 2021. In determining how many employees you have for this test, you do have to consider your entities in aggregate. So if you have commonly controlled entities, so other entities with similar or identical ownership, you may have to count the employees from all of those entities combined to determine whether or not you fall under the 100 or fewer or 500 or fewer test. And when you're looking at the wages that qualify, it's only wages that are paid to employees during a time that they were not providing services. So if we were paid them more or whatever, they can't have been providing services during that time at all. So we have had conversations with some clients who are like, well, yeah, I didn't pay my employees during the time that they were laid off. And we usually will ask, okay, did you pay their health insurance? Were they still covered under your group health insurance, and were you paying a portion of that? And if they were, then those wages, or that amount that qualifies as wages, could qualify for the credit. So even if you weren't paying your employees to stay home, keep in mind that those healthcare costs can also qualify for the credit. So the reason that we're seeing so many questions around this is that these credits are worth a lot. Back in 2020, the threshold was up to 50% of wages paid to an employee up to $10,000 for all quarters. So for 2020, the credit could be worth up to $5,000 per eligible employee. 2021 gets quite a bit more. So it's up to 70% of wages up to $10,000, but it's per quarter. So for 2021, you could see up to $7,000 per quarter per employee. So that's how you can see they add up pretty quickly with as many employees as dealerships typically have. And here on this slide, it does say the credit may be worth up to $28,000. However, losing that fourth quarter under the infrastructure bill, that actually would only be $21,000, but still those are big dollar amounts. And again, the penalties on these big dollar amounts would also be large. So taking the risk of taking it when you're unsure of whether you're qualified or not may not be worth it. And so claiming the credit, it could have been claimed on an originally filed 941. Now, third quarter payroll tax reports were due, last month. So that's passed. There's no longer an opportunity to claim the credits on a timely filed return, but there still is an opportunity to claim them on an amended return. So this is what I mean by there's still time to take the credits in the future. As long as those amended returns to claim the credits are filed within the statute of limitations, which is 3 years after they were filed, you could still go back and claim the credits. So I talked to a lot of clients about, let's just wait it out. Let's see what happens. If we're unsure whether or not you qualify for the credit, let's just see what happens. And already touched on this, but yes, if you took PPP, you can now take the ERTC, and you can go all the way back to March of 2020 to determine whether or not you qualify. But do keep in mind that any wages that were used to apply for PPP forgiveness cannot also be used for the ERTC. We do believe, though, that if you filed for forgiveness and had excess wages, so in other words, you had more wages on the application than you needed to qualify for full forgiveness, that those excess wages, if they were ERTC eligible, so wages that you paid to an employee while they weren't providing services, that those could be used for ERTC. There is some question there that once you put them on the PPP forgiveness application, that maybe they wouldn't, but as long as they weren't actually used in the calculation or they weren't needed to qualify for full forgiveness, that they could be used for ERTC. So just mentioned it, but this goes for any of these employment-related tax credits, that there is no double dipping. So wages that are used for one credit cannot be used for another credit or another program like PPP. So as you're tracking this, make sure that whatever you're not double using any of your wages for any of the credits. And I'll mention the work opportunity tax credit. This is one of those that, the dollar amounts that we're talking about are much less than ERTC, but it is a credit that's available through the end of 2025. So there's still plenty of time to claim these credits. So it's definitely an area that employers should look into. They would encourage them to look into. It's a wage-based credit, and it's basically a program that's used to incentivize employers to hire individuals who face barriers to employment. And so there's specific groups that they've identified that often face these barriers to employment, and they want to encourage employers to hire these people by offering them a federal tax credit. And so a couple of the areas is, veterans, food stamp recipients, ex-felons. There's a few different areas that an employee can qualify under. And like I said, it is a federal income tax credit, and we have this available through the end of 2025. So even if you haven't been doing it prior, knowing that you have several more years to claim the credit for your new hires, it definitely might be a good idea to look into. So, in general, for dealerships, we see about a 5 to 8% qualification rate. So about 5 to 8% of employees that are hired are qualifying under one of these categories. And the groups we see most often are food stamp recipients, the TANF, which is the Temporary Assistance for Needy Families, and veterans. Those are the areas we see the most. And typically, it's about a $1,900 per eligible employee. It is a somewhat administratively burdensome program at first. So I'll talk a little bit about providers and what they can do to help with this process in a few, but just know there are very strict deadlines around the timing of screening and applying for the credits. It is administered by each state. So at the state level, it's a federal credit, but it's administered at the state level. So if you have employees in multiple states, you would be dealing with multiple state agencies to claim the credits. But there is no limit on the number of new hires that you can claim the credit for. But it is only one credit per new hire, and it does have to be a new hire. They can't be rehires. And the value of the credit is actually determined on how much the employee works. So they have to work at least 120 hours within the first 12 months. And if they work, as you can see, between 120 and 399 hours, the credit's worth 25%. If they work more than 400 hours, it's actually worth 40%. So the more they work, the more the credit's worth. And another thing to mention, for most categories, it's the first 12 months of employment. For the temporary assistance for needy families recipients, it's actually the first 24 months. So like I mentioned, using a provider for this is what most people will do. The providers will provide a screening tool for the employers. They'll be the ones who communicate with the state agencies and take care of, timely filing and tracking and monitoring all of this. And then they will actually, in the end, calculate the eligible credit so the employer can then just go ahead and report that on their federal tax return. And so all that leaves for the employer to do is to make sure that the individuals, employees have access to the screening tool and complete it timely, and then provide the provider with what they need. A couple of other credits wanted to mention. This one seems to be a little unknown, is while we know that there's credits out there for paying your employees for sick and family leave time for COVID, this actually also extends to recovery from vaccines. So they don't have actually had to have had COVID for you to qualify for these credits. If they just need time to recover from their vaccine, they can also, you can also claim the credit for them. And so this is also used to incentivize employers to pay your employees while they, for a few days while they have to take time off. And then you can get this credit. And the credit for sick pay is $511 per day, up to $5,000, or if it's family leave, it's $200 per day, but up to $12,000 total. So, and this is, again, just like the ERTC, it's going to be claimed on your payroll tax return filings, either on timely filed, or if you realize you qualified and can go back and amend, that's also an option. Another credit available to employers is the retirement plan startup credit. And this can be claimed for up to $5,000 up to 3 years for the cost of starting a qualified retirement plan. And the key here is it does have to be a new plan. You can't just shut down your old plan and start a new one and qualify for the credit. This has to be a brand new plan. And so, if you recently opened a new store, purchased a store, this is a pretty easy credit to qualify for and to take. It does have to be, you have to be a small employer, so you have to have 100 employees or fewer. But each of those employees has to have at least $5,000 of compensation. So like I mentioned, with the new tax legislation, the infrastructure bill and the Build Back Better bill, there's constantly changes, and this is why it's in the news all the time, is because every time we think we know something, we find out that it's been taken out or changed. So this chart is really interesting to look at because it really shows you the original Biden proposals, a few key parts of it, where we got, about a month ago with the Ways and Means bill, and then where we're at as of about a week ago. So, the Biden proposal started out very ambitious, talking about increasing tax rates for corporate, for pass-throughs, or, at the individual level, so essentially hitting pass-throughs. Also capital gains rates. So across the board, really increasing taxes on a good chunk of the population. The Ways and Means bill changed some things. It had a provision about, that really would impact dealers on the qualified business income deduction. Right now, dealers who have a pass-through entity, so an S corp or partnership, are getting, potentially a 20% deduction for the qualified business income deduction. This was going to cap that. But as of the most recent bill, that's been removed. All of the tax increases have pretty much been removed, other than the surcharge, which I'll talk about next. But this is still in negotiations. We don't, the infrastructure bill has gone to the president. We expect it to be signed into law. But this bill, this recovery bill, we're still waiting for them to continue to negotiate. And there are some that think that the good Democrats have momentum now and they're going to get it through, and then others that think that they've done something that they'll get a lot of pushback and they won't get this before the end of the year. So stay tuned. We'll continue to watch it. So key things for individuals: there is a surcharge proposed on all income over $10 million of 5%. And then for income over 25 million, it's actually an additional 3%, so 8% total surcharge. For capital gains, like I said, the capital gains rate is not actually increasing. This is a little misleading the way it reads. The capital gains rate itself is not increasing, but capital gains would also be subject to the surcharge. So while we'd still have a 20% capital gains rate, you'd have that additional 5% surcharge on top of it if you're over $10 million. And then over $25 million, an additional 3%, so you'd be at a 28% capital gains rate. There's also a provision in there now to make the business loss limitation permanent. So way back in 2018, when tax reform became effective, there was an excess business loss limitation where businesses or individuals could only take a loss of up to $500,000 from their businesses. So if you, in all of your businesses added together, had a loss of more than $500,000, you were limited. And then that would carry forward as basically a net operating loss. So that is set to sunset, but the new bill is considering making that permanent. And it would no longer be grouped with net operating losses. Instead, it would stay in its own category of carry forward as excess business loss limitation carry forward. So another big thing for individuals is this 3.8% net investment income tax. So right now, the NIIT only applies to investment income. So your interest expense, your dividends, your capital gains that aren't business related, those have an additional 3.8% tax on them already if you are a joint filer who makes over $250,000 a year. What they're proposing is that the NIIT would actually apply to all income over $400,000 for single filers or $500,000 for joint filers. So rather than having just on investment income, they're talking about just applying it to all income. And that's, again, still in there now. We will see if it makes it. The estate and gift. So yeah, if you've had your CPA and your estate attorney talking to you about making sure that you get your estate planning done before the end of the year, this is probably what was driving that. Right now under current law, we're in a very favorable spot where we, have a really high estate and gift tax exemption of almost $11.6 million per person. And we have step up in basis at the date of death. It's very favorable right now. Those rules, or at least the exemption of $11.6 million is already set to sunset in 2025. It will back to $5 million. That will be indexed for inflation. So we think it'll go down to, maybe $6 or $7 million. That's the estimate at this point. But getting that estate planning done now in plenty of time before 2025 is important. But what the Biden administration was proposing was they were proposing basically reducing that earlier than 2025 and eliminating the step up in basis on assets inherited at death. So that was a big one. So then the budget reconciliation legislation that came out suggested a few other things. One of the items was not allowing valuation discounts on properties and things like that. But at this point, everything in those right two columns has been removed. It doesn't mean that we couldn't see some of those things come back in, or that, if they try again in a year. These are the things on their mind. These are the things they're considering doing. So definitely, I wouldn't just write them off as something that's never going to happen because they didn't get it through this time. Things that just keep in mind that these things could be out there. But for now, current law, we've got some great rules, great time to do some estate planning, great time to get everything in order. So if we do see changes, you're prepared. And I am running out of time, so I'm going to go through this pretty quickly. But there is a few states have come up with a workaround on the SALT cap. So starting in 2018 with tax reform, we saw a reduction in the amount of state and local taxes that could be deducted on an individual's 1040. So we were capped at $10,000, and that's your property taxes and your state income taxes. So, most of our clients were, getting up about that $10,000 just with their property taxes. And so they weren't really getting any benefit for their state income taxes that they're paying. And so if you're in a high income tax state, you lost a big deduction there. So the states have come around and come up with a workaround, but it only applies to pass-through entities, so partnerships and S corporations. And it will allow partnerships and S corporations, and again, every state's rules are different. Every state has a different way of approaching this. So, when I say how it will generally work, it's a big generalization. You'll want to make sure you look at your individual state to see how they're going to apply the rules, if they're going to. But essentially the way it will work is the pass-through entity will pay the tax at the entity level, and then the individual will actually get a credit against their income, their state income tax. So you're getting the deduction at the federal level at the entity, and essentially you're getting the deduction without having to claim it on your individual tax return. There is the talk right now of reinstating or removing the SALT cap in the tax legislation that's going into play right now. There's a lot of back and forth on that. There's talk of only raising it up to $80,000, but this, at least, if nothing happens with that legislation, some states already have a plan of how their at least their pass-through entities could benefit. This map, the most important thing is that darker blue color are states who have enacted legislation effective in 2021. The lighter blue are states who have enacted legislation effective in 2022. And here's just a list of the states that are working on it or have already passed some type of pass-through entity legislation. These are brand new laws, and a lot of them already need some fixes. But these are just a few items to consider. Make sure that you know how the election works. When is the deadline? How is it made? How may it affect your non-resident filers? How may it affect your non-individual owners of your pass-through entity? So if you have a partnership who is an owner of the entity, or a trust that is an owner of the entity, how does this election impact them? And then how are estimated taxes supposed to be made, when, and how? So before you skip your fourth quarter estimate, or before you make your fourth quarter estimate, it's really important to run some projections to determine whether you're going to benefit. It's going to be different. If you're a part of a partnership, you may be able to, depending on your own state's rules, you may be able to, opt out while your partner opts in to the pass-through election. S corporations, you're going to have to all decide, all these shareholders are going to have to determine whether or not they want to make the election together. So definitely some things that you need to consider before moving forward with this. And then also, like I said, keep an eye on the SALT cap at the federal level, because if that goes away or gets increased significantly, this will be much less of an issue in the future. Couple quick reminders before we wrap up. Tax reform, we're starting to get into the period where some of the things that were part of that law are either sunsetting or had built-in changes as the years went on. And the biggest one that impacts dealers is the 163J interest limitation calculation. So since 2018, in calculating your 163J interest limitation, we've been able to add back the depreciation expense. Starting in 2022, we no longer add it back. So where this is going to have the biggest impact is probably going to be on dealers who have rental fleets. So if you take the bonus depreciation in 2021, and then you're not able to take it in 2022 because your calculation has changed because you don't get to add back the depreciation, you're going to see a big swing in income. So you're going to have big deductions in 2021. You're not going to have those deductions in 2022. And, if we're talking about going into a higher rate year, potentially, as like I said, there's a lot of unknowns there, but if we're looking at potentially higher rates in 2022, swinging income into 2022 doesn't make a lot of sense. So it's just an area to watch. And obviously you wouldn't have to make the decision on whether or not to take bonus on a rental fleet in 2021 until you file your return. So we get to wait and make that decision, but just something to keep in mind to make sure that, you're not pushing income into a higher tax rate year inadvertently. Another area this may impact dealers is if you have financed your store purchase, so you have a lot of interest expense, acquisition interest expense, or if you have large goodwill amortization, you may end up in an interest limitation where you haven't before. So just an area to be aware of in planning for 2022. And I won't go over this, but these slides will be available. Couple other areas for tax reform. Tax reforms removed the carryback option for net operating losses. However, the CARES Act did suspend that, or reinstated the carryback basically for 18, 19, and 20. So you do have the option now of carrying net operating losses back in those years. So it's probably worth, if you had big losses in any of those years, looking back and deciding whether or not a carryback makes sense. And then also for the carry forwards that you may have done, because if we couldn't do a carry back, we could do a carry forward. Beginning in 2018, we were actually limited to only 80% of our NOL carry forward each year. So since the CARES Act suspended that, you could go back and maybe get 100% of your NOL for any of those years. And I already mentioned the excess business loss limitation, but it was suspended as part of the CARES Act for 18, 19, and 20. So here's an area where if you had those limitations, taking a look back and make sure you're not missing out on an opportunity to get some additional deductions. And that's it. I thank all of you for joining us.
Brianne, we love having Moss Adams on. You do a great job of breaking down all this information for us into digestible pieces, and just thank you for doing that. Again, to those on the line, you will all be receiving a copy of this webinar by the end of next week. If you would like the slide deck sooner, just shoot me an email. Join us back here on Thursday, yes, 2 days from now, November 11th, at 2 p.m. Eastern, as Strategic Source discusses the biggest cost reduction opportunities right now. For more information about AIADA, visit AIADA.org. Thanks for joining us and have a great day, everyone.